Good afternoon, everyone, and welcome to Scotia iTrade's webinars. Today's topic is on cash management using ETFs with Horizons ETFs. Let's do a quick audio test before we get started. If you can hear me clearly and the sound quality is great on your end, please click on that hand icon in the control panel. Also, if you are experiencing audio difficulties, you can always click on that sound check link, or sometimes it may show up as a settings link in your audio panel. And as always, the setup window may show up on your secondary screen if you are using two monitors, and everyone is muted for sound quality purposes. And if you find that you did join using your computer as speakers to listen, you can also, and the audio quality is not great, pardon me, you can always dial in using your telephone, and don't forget to enter the access code and the audio PIN ID. And just as a reminder that Scotia iTrade does not provide investment or tax advice or recommendations, and nothing in this presentation is or should be construed as investment or tax advice or recommendation to buy, sell, or hold any security or to follow any particular investment strategy. Today's presentation, as with all of our presentation, is strictly for educational purposes only. And we did get a chance to use that control panel. I do want to note that the GoToWebinar platform does automatically hide the control panel or the toolbar for you. And if you do want to make it visible, you can always click on that arrow icon. And you are also welcome to view in full screen mode by clicking on that full screen icon as well. And click on the hand icon if you have any questions. And as always, you are welcome to type in your questions in the question panel, and our presenter will address them either as they come in or at the end of the session. And we are recording today's session, and if you did select yes on the registration page, we will email you the recording. You can also access our past webinar recordings on our webinars on demand page under the Learn and Do More section of scotiaitrade.com, or email us at education@scotiaitrade.com to request a copy of the recording link. And you are also welcome to take notes. However, I will make today's presentation available for you to download at the end of the session. I do want to note that it won't be currently visible in the handouts panel, but will be so at the end of the session. And today's session is part of a learning series that Horizons ETFs offers. So cash management using ETFs is part of Series 2, Strategies Using ETFs. And if you didn't get a chance to view any of the past webinars in this series, you're also welcome to view them going to our Webinars on Demand section as well. And our presenter today is Jamie Purvis. As Executive Vice President, he includes among his responsibilities the development and delivery of strategy and content in the Self-Directed Investor channel. Additionally, he leads educational campaigns for Horizons, such as the highly acclaimed Horizons ETF University series, and is a frequent speaker and panelist at industry events and commentator in the press. A Queen's University graduate with an honors degree in political science, Jamie was involved in the original development of Horizons ETFs and has been with it and predecessor firms since 1995. Jamie represents Horizons ETFs on the Alternative Investment Management Association, the global organization for alternative investment operations and management, and is the past chair of the Canadian Retail Sales Practices Committee. Welcome, Jamie.
Thanks, Rose. Always a pleasure to be here. Let me see if I can make things work. Welcome, everybody. Rose, how do I advance the slide? Oh, there we go. First slide.
Let me just give you that.
All right. Yeah. Folks, it's been a couple months since I've done one of these, so I have to get caught up on how the technology works. But welcome and thank you for joining us today for cash management using ETFs. The timing on this is very interesting. We have a Fed announcement coming up this month. We have a number of issues facing us from an interest rate perspective. We have a Donald Trump presidency. We have the end of year one of Justin Trudeau's prime ministership of Canada. A number of factors contributing to that's just a short list that are contributing to our rate scenario that we exist in right now. And what we want to talk about today is a little bit about cash management using ETFs and how ETFs can perhaps help you in this environment. Rose, again, I seem to be unable to forward the screen. Okay, so here's our agenda for today. First thing we're going to talk about is this quest for yield. We're going to talk about the impact of demographics here, the forecast for the future and the current reality, a little segment that we call Why Cash is No Longer King. Talk a little bit about cash alternatives, what other kind of products out there exist, and then finish with a little bit on some of the Horizons solutions in the cash space, potential solutions that are our active, what they're called our active floating rate ETFs. And then we'll summarize it. Ideally, this should take about 45 minutes. I do encourage you to ask questions throughout. I will keep an eye on the message box to do so, and I have had one question submitted to me already by a client. I'll be happy to, I'm going to address it towards the end because it'll make much more sense to answer the question at the end after we've seen some of the slides that we're going to talk about today. So let's just look at demographics and think about the impact this has in Canada. And I think we really think about cash as almost a fixed income instrument in some cases. And this is why we look at this table and why it's so important. If you look at the percentage of Canadians aged 65 and over, historical and projected, it's quite a staggering shift. I will say that this almost exact shift shows to be true in the U.S. as well. So this is a North American phenomenon. In truth, the phenomenon exists globally, but in the first world nations, particularly in North America, also in parts of Europe, we see a lot of this happening as well. And this is simply the amount of the percentage amount of the population that is age 65 and over. And why 65 and over? Why does it matter? Well, demographically, that's the retirement age when we look at it. And if we think about what that means for investing and how much more secure those portfolios need to be, because you can't afford to take a loss as you're attempting to fund your retirement. We're going to show some slides on that later. This has a significant impact. What this really means, if you think about this just in the simple context of the old adage that you own your age in fixed income and the rest in equities. So what this means in 1971, about 7.5, and pardon me, there's a little skew on the numbers on the left side of this chart, but it actually starts at zeros at the bottom, and then 5%, and then 10, 15, 20, 25, 30. What we see is that in 1971, about 7.5% of the population of Canada was over the age of 65. And in 2011, that number was actually up to almost 15, so it essentially doubled in 2021, which I'm aware also all of a sudden becomes not that far off. We're looking at 17.5% and up, sort of capping out around 25% through 2041 and on. This is, however we're going to attribute this longevity, this increased longevity and the increased population, it has to do with people living longer, not just living longer, have more people living to the age of 65, but living well beyond. If you look at the actuarial tables, the life expectancy for Canadians has shifted dramatically in the last 10 years. So it means that not only do we have the baby boomers, this massive wave of post-war born people hitting the age of 65, they're not just that many more hitting 65, they're lasting well beyond that. So it means that we've got more demand for fixed income and a more lasting demand for fixed income as what people think is the safe haven in their portfolios. And of course, in the current rate environment, this is causing a bit of a scramble. So we're gonna walk through some of the impact of this. But what this means, there's going to be great demand on cash and fixed income instruments at a time where historically they're paying very low yields from an interest rate perspective. So what impact does this have on you, and where do clients look for that, what we will refer to as this accretive return, like a couple extra percentage points here, or extra percentage point here and there, can make a big difference to effectively funding a retirement. So now let's start with, sadly, the bad news. We are at the tail of a bond bull market. It's 33 years or so in the making. This is just looking at the U.S. 10-year Treasury yield. The Canadians are very similar, but the U.S. numbers are more widely quoted, so we use this here. We look back to the beginning of 1985. We had a 12% interest rate. I mean, I think many of you on the line might recall when we were able to get 12% on a GIC sort of thing, or a little less than that, maybe 9.5% on GIC. And people were, as rates started coming down on GICs, people migrated to mutual funds because mutual funds promise equity returns. And people saying, okay, I have based upon the boomers' age trajectory, because okay, I have a certain amount of time, I have a good 25, 30 years perhaps to retirement, I can afford to take more risk in my portfolio in equities. And of course, we saw a tremendous equity bull market from about 1982 to the year 2000. What happened in this period, though, is that yields came down. Right, the government, the U.S. government, the government of Canada, were paying less and less for you to lend them money. Essentially, keep in mind, that's what a bond is, right? You're lending someone money. They're paying you back interest every year until they repay the principal. And what it becomes evident from the slides that they became less and less willing to pay you that yield. and there's less and less demand for it. So the yield has dropped precipitously from 12% to around 2% in the U.S. on a 10-year Treasury, which is, it's 1/6 of what it was over that period, what it was at the beginning of this period. So, of course, what does this mean for bond prices? It means that bond prices fall because every new issue that comes out of lower interest rate, because it's paying less interest, becomes less valuable to the current bond, to people that currently hold bonds. So makes old bonds more valuable, and new bonds become less valuable because they're paying less interest. So bond pricing on old bonds, bonds went up. The more mature bonds that you held, the value went up because their interest rate was so high, but the yields kept coming down. And where we hit at this point is really a place where bonds can't go much lower. So if we think about low rates, it used to be cash was often thought of as king because it was very useful, but banks use that short-term bond rates to fund the interest rates that they pay on deposits, money market funds, and high-interest savings accounts. But when rates are at a record low, or at record lows, I beg your pardon, the interest earned on that cash can be negligible. It's important to note that rates and inflation are not necessarily related. So the graphic here that our marketing team are quite fond of here is that with inflation and low rates, you're going to need a bigger mattress to maintain the value of your cash. So now we're going to sort of add something into that idea of where we were on the bond chart that we showed a couple slides ago. And this graph actually shows the real rate of return that an investor would have received had they invested in 1-year U.S. Treasury bonds, less the annualized change in the Consumer Price Index, or CPI, which is essentially an inflation indicator. The annualized change in the CPI was approximately 2.42% as at November 30th, 2016. So an investor has to earn a yield in excess of that change in CPI to generate a positive real rate of return. So what I mean is, for your dollar to have keep its purchasing power, the rate you're getting paid on holding that cash has to be better than 2.42% over that period of time, or at any point in time on this chart. But at November 3rd, 2016, it's got to be over 2.42. And what you can see from this chart is we go back to the beginning here in 1984 when we were looking on the chart 2 charts ago. We had a 12% return on the 10-year bond. So let's say it's 10 on the or 9 on the on the 1-year bond. You subtract the CPI there, you're still making just over 8% back at the beginning of this chart. We've seen a couple spikes, of course, over time, the biggest one being 2008, 2009, when equity values dropped precipitously. But right now, and we've seen dips prior to what happened in 2008, 2009, and again since then, where you're getting negative yield, meaning owning a 1-year Treasury bond is costing you money when you adjust for inflation. So even now at this point, at the end of 2016, a 1-year bond on the U.S. is paying you 0 when you adjust it for 1-year inflation. That's quite something. It essentially means you're staying at the same cash level. Your cash is worth exactly what it was at the end of that 1 year that it was before. So you're not making any yield on it, adjusted for inflation. Now you're not losing. That's good, but we don't know where this chart is going to keep going. But we've certainly seen some trends here in 2008 and again in 2011 where you've seen it bounce to quite a negative number. So what are the alternatives to cash? Sitting in cash or the mattress approach may not be the best idea. Historically, investors have been able to invest in short-term GICs, high-interest savings accounts, and money market funds to enhance their yield on their cash holdings with little to no risk. Right? Those are all very, very safe, and in most cases guaranteed places. But these savings vehicles currently offer no opportunity to earn a reasonable yield that will outpace current and projected inflation after fees and expenses. So let's think about what makes a good cash alternative, and we've got a table on the next slide that will sort of visualize this for everyone. But you're looking for something with a low management fee, right? The higher the fee, the lower the return. This is true in all investing. And if we think back to the beginning of 1985 when U.S. 10-year is paying 10% or 12%, you don't mind being in a vehicle that costs you 2% because you're still netting out 10%. But in an environment right now where we're getting 2% yield or something similar to that, the cost of your investment is really important. So you're also, and we'll show some slides on that coming up as well. If you think about your yield, and going back to the previous chart, the yield has to be higher than CPI inflation. you're looking for cash alternative has to be highly liquid, meaning it can be sold quickly and efficiently, and ideally it must have low risk, a very low probability of losing money, or the low probability of losing a little bit of money. So here are some ideas, or an assessment, I beg your pardon, of some of the things that we've mentioned as alternatives to just holding cash under your mattress. So the first, of course, is the high interest savings account. The risk is very low because the principal protected up to $100,000. Current yield, and this is in Canada, and this is sourced through the top 5 Canadian banks as at the end of November of this year. The current yield on this is about 0.53%. It has no duration, it has no management fee, so your net return is 0.53%. And we're going to talk about duration a little bit, but essentially this portfolio high interest savings account has no sensitivity to an increase in interest rates. So let's look at money market funds. Risk is very low. Current yield right now average is about 0.27%, and its duration, meaning its sensitivity to an interest rate increase, is about 2 months, which means about 0.2%. And we'll go through that in a little more detail going forward. But a high management fee, about 0.7% on average. For those of you holding U.S. money, U.S. cash, which many people do because they they spend part of the year in the U.S. or they believe in the U.S. economy or the balance sheet. Again, risk is very low. Current yield is about 0.4%. Duration again is about 2 months, or 0.2, we'll call it 0.24%, and a management fee of 0.27. So U.S. money market funds are much cheaper than they are. Money market funds in the U.S. are much cheaper than their Canadian counterparts. Then we have a couple of ETFs down here that come from Horizons. HFR, which is the Horizons Active Floating Rate Bond ETF. Its risk is categorized as low, so it's the same as owning high-quality Canadian corporate bonds. Its yield is 2.11%, and its duration is about 3 months. So that'd be what we look at it as being 0.25. Management fee is 40 basis points, or 0.4%, so slightly higher than U.S. money market, but almost half as much as a Canadian money market ETF, and provide you substantially more return. And then for a comparison, similar product that is designed for U.S. cash or fixed income is HUF.U, denominated .U because it trades in U.S. dollars, much like exactly like U.S. money market funds. It has low risk as well. Current yield about 2.78% and has a duration of about 4 months, so what they call 0.3%. The management fee again of 0.4, so low cost, a little bit more expensive than the U.S. money market fund, to the tune of about, we'll call that about 40% higher. But if you look at the yield of yielding 2.78, we'll call it 2.8% versus 0.4%, it's giving you almost 7 times the yield for taking on another 50% in fees. So this is just looking at some of the things, some of the tools that are available out there to you as investors that can be used as alternatives to just holding cash on your mattress. So let's just talk about fees for a minute. We're going to set the table here by talking about in saying that in this low interest rate environment, more than half your yield to maturity can be erased by paying too much in management fees. So in Canada right now, a 1-year bond is yielding about 0.58%. A 10-year bond is yielding 1.66%. So you have to wrap your head around that. So you're essentially getting paid 1% more a year, or let's say about 85% more per annum to lend for 10 years versus 1 year. And the Bank of Canada current inflation rate is right at exactly 2%, which is actually the Bank of Canada's stated mandate is keep inflation at or around 2% per annum. So we look at that and say, well, so if I'm lending money to the Canadian government for 1 year, I'm going to get a yield of 0.58%, but in real terms, I'm going to lose 2% to inflation. So my net is actually only 1.42% negative. I'm actually losing 1.42%. And if I lend the government money for 10 years, my yield is actually only a negative 0.34. And that's current, keep in mind, but that's where we stand right now. So we think about all the ways that we can get access to this. It used to be people had mutual funds, and that's what I referred to earlier when we said we were in 1985 when a U.S. 10-year was paying 12%. You mind paying that mutual fund fee of about 2% at the time. Oh, I don't know what happened there. We jumped ahead. But what's happened in the evolution of the delivery vehicle is that the mutual fund has been challenged by the ETF, and the ETF simply put, and this is in many of the other presentations we've done earlier, I recommend you go back and look at ETFs 101 to get more detail on this. But ETFs are just essentially a cheaper, quicker, and more or slightly more liquid and more transparent version of mutual funds. It's just really, I think we categorize it from our perspective as an improvement of the structure, much of the same way that an iPod is a much more efficient way to deliver lots of music at very high quality audio and with increased portability versus a record player 30, 40 years ago. There's a dramatic difference in the delivery vehicle. The music is still the same, and the investment ideas are still the same. It's just the delivery vehicle has been improved. So what is an ETF, an exchange-traded fund? Well, it is like a mutual fund. It's an open-ended investment fund. And what open-ended means is that it can grow in size and the number of units that it issues, and it can decrease in size by reducing the number of units that are issued to match the demand in the market. Now, you say, okay, what's the big deal about that? Well, the difference is it means that the price and the value are allowed to stay the same thing. With a stock, which is not open-ended, typically there's a certain number of shares issued. So the supply is fixed, the demand changes, and as we all understand, very basic economics, supply and demand are the two major factors in pricing, is that if the supply stays constant, demand goes up, the price goes up. And the supply stays constant and the demand goes down, the price goes down. So you can have dislocations in what people say valuation, which is what we think about when we hear about value investing, is you're trying to buy stocks that you think are mispriced. You think they're cheaper than what their actual value is. With an ETF, just like a mutual fund, the price that you pay and the value of the unit are essentially the same thing, and that's what the open-ended nature of ETFs and mutual funds allows you to do. One of the differences between an ETF and a mutual fund is that the ETF is listed and trades on a stock exchange, like a stock. So it gives you that liquidity, that intraday liquidity of a stock, but it is a mutual fund. And in Canada, in fact, ETFs are governed as mutual funds. They're viewed as mutual funds in the eyes of the securities regulators. Of course, ETFs, we mostly know them as passive investors or index investing. So they historically have tracked a well-known index or benchmark, can be the TSX 60 or the price of gold bullion or the NASDAQ or crude oil, whatever you may want. You can probably find some of those indexes out there for you. So we mentioned that some of the ETFs we talked about out there earlier, the HFR and HUF.U, are active ETFs. And so this is the question that we get. And there's a whole segment, another presentation we've done on what is an active ETF. But in the brief synopsis is that an ETF structurally is the same thing whether it holds an index like the TSX 60 or whether it has an active management strategy that is run by an investment professional and has a unique and specific investment objective that's trying to target. So really an active ETF is just a mutual fund that has a portfolio manager that makes choices based upon what the mandate is on your behalf, rather than an index where what the 60 names in TS 60 are dictated by the index committee. So it gives the manager some discretion based upon what they see and what their methodology is in a specific space. What does an active ETF do? Well, it allows the investor to outsource investment expertise. I don't know that what any of you out there know about floating rate bonds or the floating rate market, but this is a way to, in a very cost-effective manner, get exposure to a marketplace that you may not understand the intricacies of, but may want to generate the value or the perspective of being invested there. It, of course, allows you to reduce that higher cost trading that you would be doing, even with the low cost that the good folks at Scotia iTrade provide you for. It allows you to consolidate your trades and pool with other investors, just like a mutual fund, to reduce that overall cost by putting all your investments together. And maybe more importantly, it eliminates the need for you to be on top of the traded market or markets at all times. I think this is one of the big things that's very important, I think, for self-directed investors. And many studies come out that many investors are too active on their own behalf, and they feel like they need to open that account and check on it every day and all day. And it sort of eliminates that need for you to worry about some of your positions, individual positions, if you can outsource that expertise to a third party who has that and whose job it is to be on top of the markets at all times. I think, as a retiree, you may not want to be spending all day in front of the market. Maybe you want to spend more time with your grandkids. Maybe you don't. I understand. I'm not sure what my mother would prefer, but you do need to, this does allow you to effectively spend less time worrying about the portfolio and making specific actions in that portfolio. So our perspective here is that income really matters. And if I can sort of summarize what we've said to date, is that we have a sizable aging population that's seeking income in their portfolios. And honestly, I think that they require it because they want to take less and less risk. And historically, income investing has been viewed because of the 33-year bond bull market as the less risky part of the portfolio. And we may make an argument that that might be a little bit different right now, and want to make you aware of that. But we are in a low interest rate environment, and fees impact the performance, the cash flow, and the value of investment. So if we're in a low interest rate environment, you want to keep your fees down, and you want to keep invested income. Well, Horizons Actively Managed ETFs are professionally managed. They offer low management fees. They're convenient and flexible. They trade daily. They're eligible for all the different accounts that you may want, all the different registered accounts. We have our RSP and TFSA on there, but a RIF would also be on there. And Horizons is home to Canada's first family of actively managed ETFs and one of the largest in the world by number of offerings. And on an asset base, Horizons would be, depending upon the day, third or fourth or fifth largest actively managed ETF company in the world. So you're not doing something that's unusual here. This is Horizons offers some significant solutions across the board. So we want to talk a little bit to help you understand. We've looked at the market and the risk and some of the other tools that are out there. We want to talk about floating rate bonds and how that can help you reduce interest rate risk, which applies to your fixed income portfolio for sure, but also, as we sort of talked specifically on a couple early tables, to some of the cash alternatives that you have in place. So without spending too much time on this, which reads like one of our legal documents, the investment objective of the floating rate bond ETF is to generate income consistent with prevailing short-term corporate bond yields while stabilizing market value from the effects of interest rate fluctuations. The idea in a floating rate bond is exactly like it sounds. Different from another bond, this is looking for instruments or methodology that allows your yield to fluctuate with the current interest rate, meaning if it goes up, the bonds, the floating rate bonds, the yield on those bonds goes up, rather than a fixed bond that may be paying you 1.5%. If interest rates go from, go to 3% in U.S. and Canada, the rate of floating rate bonds would appreciate. The yield paid would grow in the same amount or nearly the same amount, whereas your existing more traditional bonds would keep paying that low rate. So you'd be getting less benefit from those earlier bonds than you would be from one that pays an adjustable rate. So in this case, the ticker symbol is HFR. It's run for us by Fiera Capital. They're out of Montreal. They're one of Canada's largest independent asset managers and a huge fixed income specialization. The management fee is 0.4%, or what we call 40 basis points in the industry. It distributes income monthly and has an annual distribution of net capital gains, if any. It's eligible for all the accounts that you may want. And as of November 30th, 2016, it had a weighted average yield to maturity of 1.82% and an estimated annualized yield of 2.11% with an average duration of 0.2 years. Keep in mind that has a target to always be below 1 year and a prospectus that does not allow it to be above 2 years. That duration talk may be a little bit esoteric, but I'm going to talk about that in a couple of slides, and hopefully that will give some clarity as to why a low duration is important if you think interest rates are going up. Okay. Very similar for the U.S. floating rate, other than it has a different name and invests in the U.S. rather than Canada, and has, as a result of that, has a slightly different yield, both to maturity and from an annualized perspective, a slightly higher duration there as well. Of course, that ETF, for those of you concerned about the U.S. dollar CAD relationship there, you keep your money in U.S., we do hedge the currency exposure out in HUF.U simply because we're not trying to provide a vehicle that provides U.S. dollar exposure. We're just giving you something that allows you to invest in U.S. dollars. So in both those slides is something saying that we don't actually invest in floating rate bonds. We run a structure called a fixed for floater swap. And while that may sound to be terrifying jargon of the financial industry, it's actually a very often used by banks and other investors to get exposure to markets where they may not want to have the exposure directly. And what I mean by that is, if we look at floating rate bonds, what are the advantages? Well, they return a yield that should rise with prevailing interest rates. They provide some protection from the negative impact of rate rises, and they generally increase in value during inflationary periods. So those are all three things that we think we may, or two things, rising interest rates and inflation, that these floating rate bonds can help protect against. But what are the disadvantages? Well, they can be expensive, actual floating rate bonds themselves. The market is forward-looking, always forward-looking. If we think about how the market has priced in an expected rate increase in the U.S., it's priced that into about 100% right now. So they say that that's cooked in. All the bond pricing already reflects that. And so they can charge a premium for these bonds in a low-rate environment. And the thing about floating rate bonds is they're not necessarily very liquid. People that hold them during periods like this tend to want to hold them. And so they're not available for sale, and that there's a limited selection of issuers. If you think about it, in Canada, we're really looking at banks and utilities and provinces. If you go down to the U.S., it's utilities, financials, things like Fannie Mae, Freddie Mac, all of those things. So what I mean by this is that the floating rate bond market doesn't give you much diversification by sector in terms of who you're lending money to when you buy a bond, and necessarily how deep those markets are. So investing in the floating rate bonds themselves, it can be a tricky operation, especially for non-professionals to run. So in this case, this is one of the scenarios where you may say, I would rather have someone do this for me because I understand, I like the fact that they return a yield that rises if interest rates go up and that they increase in value during inflationary periods, but I don't have the wherewithal to manage this kind of portfolio myself. So in giving you the best of both worlds, the Horizons Active Floating Rate Bond ETFs, they own high quality and highly liquid corporate bonds. And the yields on floating rate bond ETFs are generally expected to be higher than most floating rate bonds. We use what's called an interest rate swap to ensure that the ETF, so HFR, always receives, now this is again, that don't be overwhelmed by the verbiage here, the Canadian dealer offer rate, which is the floating interest rate that Canadian banks use to lend to each other. So by using this, what we call the fixed for floater swap, we're trading away the yield and the duration of the basket of corporate bonds, and in return, we're getting this Canadian dealer offer rate, or CDOR, plus the difference in bond yields between corporate bonds and government bonds. I know that sounds complicated, but what you're also getting there, so let's say you're getting 2.5%, we'll talk about the numbers again, especially in a second, but you're trading away the duration of that basket of corporate bonds, which is about 3.5%, 4%, for duration of about 0.2%. So what you're doing is greatly reducing the sensitivity of that basket to increasing interest rates, and thus the yield should rise if those rates go up, and protecting the portfolio from the negative impact of rate rises. So if we think about this, again, we're going to take the slide from the very beginning, the 10-year U.S. Treasury yield. If you think it goes back to this point here in 1985 is where we actually start ours, which is at the second peak. But if you go back before that, we're actually in a 20-year plus bond bear market when rates were going up. And if you held an existing bond, every new issue of bonds that came out over the years was paying more and more interest. It meant that your bond was worth less, and the bond you were holding is worth less in value. So that ended, and then we went into what's now almost 34 years of a bond bull market, I beg your pardon. But the reality is rates can't go much lower. Right? I mean, we have seen some zero interest rate policy in Europe, some negative interest rate policy in Europe, which is mind-boggling, which means you're paying the bank to hold your money or paying the government to hold your money for a period of time. Who knows? Do rates go up right away? That's not our job here at Horizon to forecast, and we're not here to give advice. We're just here to educate and tell you about what happens in the space. Maybe we see Japan, where we have a flat, nearly zero interest rate for 30 plus years. In this case, though, it certainly looks like there's not much room for bonds to keep going down, or rates to keep going down, and as such, that will stop driving the price or of the bonds up. So we'll see, if we see an interest rate rise, we'll see the value of the bonds, current bonds, going down. you say, okay, Jamie, I'm starting to wrap my head around this. Is there anything else I need to know? And the reality is, yes, there is, because it's not just rates that matter with your bonds. The duration matters as well. So what we've done is put together a chart here that shows on the y-axis is the yield of what is the Canadian bond universe in this case, back at say to 1997. So the orange line is yield. In this case, you can see it's about, we'll call it 6.25%, 6.33% on the far left. And on the, of course, the x-axis is just the time. The black line is the duration of the portfolio. And duration is effective, I've said this a couple times before, the sensitivity of that fixed income portfolio to a 1% or to any change in interest rates, but typically viewed as a 1% increase. So here the duration is 5.5 years. That means if interest rates go up 1%, your bond, let's say it's a $100 bond, will go down, you translate this years into a percentage, will go down 5.5%, meaning the value of your bond will be $94.50. Now, back in 1997, that didn't matter so much because your yield that you were getting every year was 6.25%. So essentially, you lost less than 1 year worth of yield. If you're holding a broad bond portfolio for 10 or 20 years, you're not going to worry about that too much. But what we've seen over time is the duration has actually gone up. So that sensitivity, almost the volatility of bonds, has increased, while the rate, the yield that you're getting paid to own those bonds, has gone down. So in the green circle on the far right of this table, we see that now yield is 2.5%, and duration is over 6%. So that means if rates go up 1% right now, a $100 bond will be worth $94. But you're now only getting just over $2 a year in income or yield off that bond. I mean, it's going to take you 2.25 to 2.5 years of income to make up for the loss in value of that bond. Now, if you're going to hold that bond to maturity, then you're not going to worry too much about that. But the reality is you cannot ever forecast your ability to hold that bond to maturity. If interest rates keep going, start going up, and duration's there, and it goes up more than 1%, it goes 2% or 3%. All of a sudden, now we're talking, you're going down from $100 to $94 to $88, a 3% interest rate hike. You're down, your bond value is $82. What is your individual sensitivity to that volatility in the part of your portfolio that historically has had no volatility? It's been on a huge bull market. So if people start seeing negative numbers in their fixed income part of their portfolio, how able are they to withstand the desire to liquidate that part of the portfolio? So if you're going to hold a bond to maturity and guarantee yourself you can do that, then you don't worry about this. But the reality is, in the field of investing, where there's so much behavioral finance theory in place, it's very difficult for people to stomach that sort of paper loss, and they may want to be moving out of that position. So the reality is that the broad bond universe has become much more risky, statistically speaking, and quantitatively speaking, than it was 15 years ago or even 30 years ago. And this affects your cash as well. This is simply a different slide, a different way of showing what I showed on the previous table. So I don't have a ton of time, so I don't want to spend too much time on this slide, but I think you're welcome to have a look at this. But the reality is that in 1990, when your coupon was 10.5% and your duration was 10 years, interest rates went up 1%. You didn't matter. You're still up 50 basis points or 0.5%. In 2016, the coupon is now 1.5%, and your duration is still 10 years. What this means is that you're losing 8.5%. The math is slightly different on this slide versus the previous example, because this is a hypothetical with round numbers versus a real time on the previous slide. So where do you go for yield in every part of your portfolio? And this is the credit ladder that we talk about here. The most assured people to lend money to is the government, and then corporations, and then preferred shares. Then you get his senior loans and high yield bonds, Then you're at dividend-paying stocks, which I think a lot of people are saying, okay, I don't want to own bonds, I'm going straight to dividend-paying stocks. There are a lot of places in between, from regular government debt to dividend stocks that have lower levels of risk and lower levels of yield than dividends. And then, of course, covered call writing, which we're happy to talk about as well. So it's just something to think about here, that a lot of people jump directly from owning government bonds to having dividend-paying stocks. In Canada, we love our banks, but they do have a higher risk and higher yield. If you think back to 2007, 2008, when Canadian banks lost about 40 to 45% of their value, there is risk there, even though we think of our banks as safe havens, much the way we think of fixed income as safe haven. So I want to touch on fees briefly. I already have talked about fees, how important they are, but this is a way to graphically illustrate that for you. The chart here that we've put together shows a hypothetical investment of $100,000 invested for 10 years at a 4% per annum return, which I think we'd all love to say we'd take automatically in fixed income right now, before fees and expenses compounded daily. The black line is a mutual fund with a management fee of 1.6%. The orange line is an ETF. They're both invested in the exact same thing that has a management fee of 0.5%. What you see over that 10 years is this ETF, because of the lower fees, puts $14,294.82 in the investor's pocket just by virtue of buying the lower cost instrument. This is one of the key tenets and huge values that ETFs offer, is that they let you keep more money in your pocket. And we think about this, this doesn't just matter in the accumulation phase, this matters in what we call the decumulation phase here, where you start taking money out of your portfolio. Let's look at the impact of it, and if you look at this slide, of course, you'll see that the $100,000 invested for 10 years, the previous slide goes to halfway on this slide. Then we start taking out $10,000 a year each year for 10 years, while still keeping the remainder invested in Fund A and Fund B in both cases. The ETF at the end of this period, at the end of the 10-year accumulation and then the 10-year decumulation, now has $32,492.23. This matters when people not only we have more people at 65, but more people living longer. Your money needs to stretch, and the lower cost investment vehicles can help you do that. It's super important to think about fees, not just in the context of what you're paying now, but what you're paying when you're taking money out of your portfolio, because it leaves more money in your portfolio every step of the way. So let's recap. Why would you invest in active floating rate corporate bond ETFs? Well, most importantly, they provide a higher current income than Canadian money market securities. They have a variable distribution that fluctuates or floats with prevailing Canadian short-term interest rates. So if rates go up, it's bad for your fixed income portfolio. It doesn't have a great impact on your cash, but it does well for you. It increases your cash holdings in GICs or high interest savings account, but it does even better for you in rate rise when you're in a floating rate corporate bond ETF. You have lower interest rate sensitivity than typical fixed income securities, and that's much lower interest rate sensitivity. I think if we think about the duration that we were talking about numbers earlier, about 3 months or 4 months versus typical fixed income security basket. If you look at the Canadian 10-year, has a duration of about 7.5 or 8% right now. So way less interest rate sensitivity. That allows you to preserve capital, gives you some attractive credit risk premiums, and helps you keep your portfolio effectively diversified. So what are the scenarios and outcomes here if we think about, I talked about where the yield comes from very briefly on a corporate active floating rate corporate bond ETF, is that if CDOR at the bottom goes up, then the yield on the ETF goes down. And that's if interest rates go up, the yield on the ETF goes up. If interest rates go down, the yield goes down. If corporate spreads widen, is what that means, then that drives the net asset value or the price of the ETF down. And if corporate spreads tighten, it will drive the value of the ETF up. So what we're seeing right now is, if we expect interest rates to go up, that's going to be good for the yield. Corporate spreads currently are slightly wider than usual, so you could expect to see them tighten slightly in an inflationary environment, which would also be good for the net asset value. So to summarize the products of HFR and HUF.U are, we think, a better approach for floating rate bonds. and it can be a key component in portfolio as they add diversification, protect capital from interest rate fluctuations, and provide that variable distribution that can be expected to protect against inflation and rising short-term rates. Why this way? Well, you get an actively managed portfolio from the experts at Fiera Capital in Montreal. You do this for the low management fee of 0.4%, and we see the exposure coming through a basket of high-grade corporate bonds versus what would typically be a floating rate that only would access government securities, provincials, and large bank issuers and utilities. So at 45 minutes past the hour, I think really we just see that GICs, high interest savings accounts, and money market funds offer little or negative real rate of return currently because of their low rates. So you're looking for higher yielding instruments with low duration that can help increase yield. ETFs can be effective tools for that because they are low cost, they're easy to trade, they are tax efficient. Again, we haven't touched on that in this presentation, but they are a huge part of ETFs, and I recommend that you go see ETFs 101 to see the importance of the tax efficiency. The long and short of it is if you have a mutual fund and an ETF that do the exact same thing, by nature of the structure, ETFs are generally cheaper and more tax efficient because the units of the ETF can be held by multiple people that can be bought and sold, which causes less turnover in the portfolio, whereas a mutual fund transaction, when you buy mutual funds, they create units for you. When you sell the unit of the mutual fund, they sell the units, they sell all the stock they hold, which leaves a tax liability to the existing unit holders. So ETFs are lower cost, easy to trade, typically more transparent, and typically more tax efficient than a mutual fund that does the same thing. So at the end of the day, the idea is that in cash, there aren't a lot of great vehicles for you right now that are providing yield above inflation, but active floating rate bond ETFs can potentially enhance the yield on cash in a low rate environment while remaining relatively low risk. It's not that they don't have any risk, which is what we look at for money markets, GICs, and high interest savings. It's just that they have a relatively low risk and they have significant advantages in terms of the yield and the duration that they offer versus regular fixed income. So if you think about, say, how would I use a floating rate bond ETF, an active floating rate bond ETF in my portfolio, you can use it in two ways. The purpose of what we talked about today is to help augment the cash the yield that you're getting on the cash part of your portfolio at a relatively low risk, or you can use it in your fixed income portfolio to reduce the duration or that sensitivity to a rising interest rate environment at the same time. So multi-use, and the concept of today is to give you better yield and low duration for your cash holdings. And with that, we invite you certainly to, if you want to learn more about the products, everything is available on our website. You can also contact us via the website or on our toll-free line. We'll get back to you within 4 business hours. Always happy to answer questions. It is really important that that we're here to answer any questions that you have, and we're happy to do so. Our team are fully prepared to talk about these solutions on your behalf, or not, I guess on our behalf, for you. And with that, we do pay our legal team a significant amount of money, so we do have to show our disclaimer, which essentially reiterates what I said earlier. The purpose of today is talk about the situation in the cash markets, interest rates, demographics in Canada, and talk about some of the products that are out there that you may not know about, because a lot of people know about GICs and high interest savings accounts, money market funds, but they don't know about products like floating rate bonds and floating rate ETFs. So the idea was just to give you a little bit of education, some perspective, broaden out the horizon, and happily move on to the next stage of the curve, as Rose said, in terms of future presentations. Now, I'm happy to answer any questions that anyone might have. I don't see any in the comment box at this point in time, but I did have one that applies to where we were today. The question that's been asked is, we've been hearing and waiting for many years about a steep decline in bond NAV values due to interest rates being increased by the Fed in the States. Specifically, if a high-interest U.S. bond fund ETF has a present dividend interest rate north of 6%, would there be less pressure on this type of fund when compared to a more conservative ETF bond fund with a dividend interest rate of 3%? This is assuming there's a 75 to 100% basis point increase in the Fed rate this December. Well, the consensus seems to be we're not going to see that significant increase in the Fed rate in December. And the final sign-off here is a general answer without too many details will be just fine. So without going into the math, that, oh, sorry, Rose, I seem to have moved it here. I want to go back to another slide. Am I able to control to go to the duration slide? The question says, if you have a present dividend interest rate north of 6% in a high interest U.S. bond fund, the more interest that any bond product shows right now, the higher the sensitivity, or the higher the duration will likely be. So if we got that 100 basis point increase in the Fed rate that the gentleman asked about in December, typically a bond fund ETF that has a yield of 6% would be much more affected than a bond fund with a dividend or interest rate in a 3% range. So that's something to watch out for. It is obviously the thing is that not just to know the yield on your fixed income holdings, but to also understand what the duration of the portfolio is. And any mutual fund or ETF out there that you can go to the firm's website will show you both the yield and the duration. The higher the duration, the higher the sensitivity, which is a negative effect if rates go up. And the more rates go up, the more negative impact you see on the price of the bonds. So I hope that answers that question. I don't see any further questions, Rose. So if there aren't any, I'm happy to stick around for questions. But if there aren't any, I think I'll gladly let us sign off here at 1:51 p.m.
There were a few questions that came up, Jamie.
Okay.
I'm not sure if you had a chance to address them.
No,
Let
I
me
don't.
just, I'll call them out and then maybe you can answer. Okay.
Where do they?
So one from Philip says, pardon me?
Okay, go ahead. I don't see them in the box, that's all.
Oh, that's okay. I'll call them out and then you can answer it.
Right.
From Philip, he asked, could you give an example how you swap the fixed rate and floating rate?
Okay, so an example, without, it's not an example I'd show on the screen, although it is in previous presentations. It's essentially an agreement we enter in this case with National Bank Financial. They're our counterparty here, so Canadian Bank, where we own the basket of high quality Canadian corporate bonds, so we're lending money to companies. And the swap, in this case, we're swapping the return and the duration of that basket. So let's say it's a 5% return with a duration of 4 years. In exchange for them, we're getting CDOR, so that's the cash rate that the banks lend to each other, which right now is about, I have to think, I always say it's about 1.3. I think it's a little higher right now. But let's say it's 1.3%, plus the corporate spread, which is the difference in what people pay corporations to lend them money versus what people to lend the corporation money versus what people get paid by the government for lending them money. So in this case, let's say you lend a corporation, the corporation, when you're lending the corporation money, a corporate bond is paying you a yield of 2% for, let's say, 5 years. And a Canadian corporate bond, to simplify it, to lend the government of Canada money, they're paying you 1%. So that the difference there would be 1%. So 2% you lend to the corporation minus 1% you'd lend to the government. So it's a net 1%. So you're getting CDOR at 1.3%, and the spread between the other two at 1%. So it's 1.3% plus 1% equals 2%, and that's, 2.3%. Like you said in my intro, I'm a political science major. I'm never going to get this math all the way right. It's 2.3% would be the yield in that example.
Great, thanks, Jamie. There's quite a few questions on,
Yeah.
in the panel, so I'll just try to go through some of them.
Great.
Michael says, I do not see the advantage of not holding a bond to maturity, but by liquidating the bond and buying a new one at higher yield, your overall return would be identical. I guess that's more of a statement than a question, but.
Sure. Well, if you're liquidating a bond and buying a new bond with higher yield.
Yes, that's right.
Yeah, keep in mind, though, that one of the things in buying bonds is that the cost of trading bonds is quite high, and it's a hidden cost. So if you are buying a bond, let's say that you're buying $100 worth of bond, embedded in that cost is actually about a 3%, typically a 3% fee. And that's not Scotia iTrade's fee, that's the bond desk's fee. So when you trade in bonds, you are giving up a lot in hidden fees there. So the reality is, in the current yield environment, if you're paying 3% to sell a bond and 3% to buy another bond with yield at 2%, you're giving up 3 years worth of the new yield to make the transaction. So it's not quite as simple as it may seem. It's one of these things where you wish the math was that simple, but there are hidden costs in buying bonds. That's another advantage to having a professional transact in bonds for you, is that they understand the breadth and depth of the market. And let's say an institution who has lots of money and trades all the time and knows the market, they may be paying 50 cents on a $100 bond rather than $3. So having professional management in that space is actually essential to keeping not just your overall cost of the structure down, but your transaction cost within the fund down.
Great, thanks. Another question from Peter is, what effect would have 2 or 3 raises by the Fed in 2017 on something like HFR?
So, well, HFR, in this case, if we want to talk HUF, which is just the U.S. dollar counterpart, well, it would be good for HUF in that because the yield would go up to match, because it's a floating rate offering, the yield would go up to match those rate increases. So you would be getting additional yield without sacrificing any of the value of your NAV or much of, because the duration is so low.
Okay, great. Another one from, let me just check here.
And sorry, Rose, if I can just go back.
Sure.
Owning a floating rate bond or a floating rate bond ETF or a floating rate bond mutual fund in a rising rate environment is exactly the time that you want to own that kind of product.
Okay, great. Another one. Okay. Sorry, did you want to add more?
No, I'm sorry. I need to stop talking once I answer the question.
No, it's okay. It's hard to kind of converse back and forth here. So another one from Swan. He's asking about free commissions on ETFs for iTrade. Swan, I can send you the information to that directly, so not to worry. I'll take that offline. From Cindy, is there any 2 times floating rate bond ETF?
There are not. There are not. The only things you can do leveraged ETFs on are passive indexes.
Okay, great. And then Steve asks, oh, sorry. Go ahead.
No, I was just saying this, of course, is an active strategy, so you can't put that in place.
Okay. And Steve asks, are there any possibility to losing principal on money market fund?
This perhaps, Steve, the question's a little beyond my ken. Theoretically not, unless there's mismanagement at a firm would be probably the generic answer. They talk about these funds being money market funds in the U.S. They're all priced at $1, so they all stay at $1 and just pay out the income. And it's called breaking the buck when it happens. It has happened to a couple of companies in the last few years where the price has actually gone down to 99 cents or 98 cents, which is, I think, in simplest terms, a matter of mismanagement rather than a systemic issue. But that is sort of a broad answer. I would say that you do need to look into that and do a little research on that yourself. I'm not comfortable giving you a confirmed answer on that.
Okay, thank you, Jamie. So we're just going to answer 2 more questions. One from Michael. Are ETFs only pertaining to bonds? Not quite sure.
Oh, there's ETFs on, as I said at the outset, you can get the equity markets, you can get fixed income, equity indexes, fixed income indexes, you can get access to commodities, you can actually trade ETFs that trade the VIX, which is a volatility index. This is just in Canada. This is just at our company in Canada. You get active ETFs that trade equities actively. You get active fixed income ETFs. There are ETFs that track hedge fund indexes, that track managed futures. You go down to the U.S., there's an ETF called NASH that tracks just companies that have head offices in Nashville. So they can be equities, fixed income. They can be very broad. They can be very narrow. This is what you're seeing in the evolution of the ETF industry, is that the proliferation of ETFs means that they're getting more and more targeted and niche. You can find an ETF for not just about anything, but for a lot of things.
Great. So we're just going to answer one more question. And for those of you that did submit a question and that wasn't answered, not to worry, I have a list of those questions and I can forward them to Jamie after the end of the session. So the last one we have is, where can we find the current yield on HFR and HFR.U on the Horizons website?
Okay. So if you go to horizonsetfs.com, and it'll give you, if you go to horizonsetfs.com, it'll, the first page will come up, say country select. You select Canada, and you hit continue when the next thing comes up. Then you go to, along the top menu bar, you want to go to Alpha. So yeah, you continue. Oh, you may need to go Canada again. Thank you, Rose. Go continue. See the tag up here, it says Alpha. You go down, it's in the fixed income, it's in the middle column of Alpha. So HFR is about halfway down and HUF is second from the bottom. You click on either of those, so yeah, if you click on HUF.U, it'll take a few seconds. If you're able to click on it, there you go, and it'll tell you, so it shows you the nav. If you go down to distributions, down below, it'll tell you the most recent distributions, the yield, the distribution frequency, all of the key information that you want to get into there. And of course, we have the investment metrics would be the duration, the credit quality. You can download the prospectus sheet, the product sheet. You can download the prospectus, the fund summary. That is a regulatory document we're required to put on there. There's everything. Ideally, is on this website. We hope it's been massively revamped in the last year and a half. So there's a wealth of information on there. But like I said, you go on there anytime. You can always go up to the top and hit contact, and it'll give you a phone number, email address. You can send us a question or call into our toll-free line and answer questions anytime.
Great, thanks you, Jamie. Just want to let, I think a few people have actually logged off already, but want to let all of you know that the handout is already available for you to download in the handouts panel. And I'm just going to do quick closing remarks, and we will end the session shortly. So after you pardon me, you can access the webinar recordings on our website from next week on, and also don't forget to submit the short survey that will pop up after you exit today's session. And also Tuesday, December 20th at 1 p.m. Eastern Time, Montreal Exchange joins us to present on options trading and volatility. And also next up in the learning series for Horizons ETFs is technical analysis and seasonal investing on Tuesday in the new year, January 10th at 1 p.m. Eastern Time. And you can also sign up for other webinars on our seminar and webinar calendar under the Learn and Do More section, as well as past webinar recordings on our webinars on demand page. With that, I want to thank Jamie for doing a wonderful presentation and answering all the questions. And thank you all for joining us today. And have a great day, everyone. And again, I will submit the questions that wasn't answered for today's session to Jamie afterwards. Thanks, everyone. Have a great day.
Thanks, Rose. Thanks, everyone.